projected we would be, right? A couple of moving parts. If we go back to last week, this is what I said last Thursday. Core themes, don't sleep on these stories. Look at number 3. Trump versus Apple. Trump is not happy with Apple's India production. Will we see a threat against their ecosystem? I don't even know why I asked the question. I should have just said, yeah, we're going to see this. And then over here, you obviously already know this story, the bond vigilantes. Everybody is an expert now in the United States Treasury markets. Banking M&A is starting to pick up a little bit. The unknowns remain a problem and shipping rates picking up. So look, we were on top of it. All of this stuff will show up in your Barron's this weekend, as is. Across the board right now, VIX is up 7.3%. Interesting day yesterday. There was a big fake out. We had a period of time in the last 48 hours where both a combination of the VIX and the SQQQ looked like they were about to break out. We had a market reversal that basically the wall of worry that we talk about on a regular basis started to get climbed yesterday. Hello. There we go. See that little squeeze yesterday, and now here we are selling off to start the day. This is the TQQ that I'm following. It is down 5.3% today, and we're heading into a long weekend, but I will remind you that you want to pay very close attention to the 20-day moving average, and we are closing in on it now. QQQ just up 1.2% from its 20-day moving average, and the XLE, which I started to take aim at again 2 days ago, dropping under that 20-day moving average, moving lower on the MACD. I still see a lot of weakness in the energy space. Bonds are down this morning. That is obviously linked to concerns about the economy. If we start taking aim at India, we'll talk through Apple coming back to the United States, what that would even mean. More importantly, I advise you to pay very close attention to the AAPD. The AAPD is the inverse bear ETF for Apple. And once again, it started to move above its 20-day moving average 3 days ago. So I'm not a conspiracy theorist. I just don't believe in coincidence. Apple breaking down. We have this move already. Momentum turning against Apple. Broader market concerns and my intraday scores are really looking bad. This is intraday momentum. This is not the daily momentum. This is intraday. The selling continues to pick up. It is in the underbelly of the market. It is not necessarily in the Mag 7 stocks. It's in the bottom 493 stocks. But pay very close attention to the Mags. Currently, right now, above 2.5% above its 200-day, 20-day moving average. And then watch the FNGD, which, again, is my core line in the sand, the confirmation that I have. We're only 6.4% away, but this is divided by 3 in order to get the correct math behind it. Well, 6.4 divided by 3 is 2.15, somewhere in that range. So only 2% below, and we're starting to see that turn. Again, a lot of concerns about trade, a lot of concerns about the EU slapping 50% tariffs to try to bring everybody back to the table. Greece coming out and saying, you know what, we really can't afford 5% to pay for NATO. There's some problems here. And this all goes back to the narratives I said about 3-4 days ago. Get ready for a narrative shift. Get ready for things to change. Get ready for everybody to suddenly get bearish. Well, it dropped on a dime at the exact same time that there was no selling pressure in the market. There was no selling pressure. And this is exactly kind of the contrarian view that we have to have when it comes to markets. I always tell people, when we get into these stretched periods, you've got to start to pay close attention to why the market can go the other way. A lot of people don't think about this. They think that markets can just keep running and keep running and keep running. It's not how it works. They take breaths. But the reality is, there is this kind of air pocket to the upside now, or forgive me, to the downside now. And what happens is, to take you through kind of how the markets work. Like this is kind of just observational. Okay. What happens in these environments, and don't be shocked if a bigger sell-off is coming. I'm going to kind of walk you through exactly what to expect. What happens is there is a sell-off, and this is what happened back in February. And when we got down here, there was no buying pressure. Nobody wanted to buy. So funds do not try to continue selling. Effectively, what happens is you have a bit of a short squeeze, and then that effectively wipes out, covers all the shorts. There's some rushing to add exposure. You start to see issues involving passive flows. There's not a lot of bad news. There's kind of this bad news is bullish stuff. There's no liquidity injection. What happens in that environment is it just becomes this pattern where then the max pain really comes. So it's a sloping move to the downside, a little bit of a squeeze, and then a straight shot down. And just to give you a reminder, this is how it works. It's happened time and time again. That is the crisis around the Nikkei right here last August. Slope down, up, down, like up, down, just absolutely jars out. This is what happened last time in 2022. This is the gilt crisis. Sell off, slope down, breaks the 20. Same thing happened. Largest hedge fund sell off in 15 years, June 2022. And then you go back and you look at COVID. Same thing. Sell off, pop, straight down. So this is why, if we're getting in this environment where there could be a pronounced sell off and we do drop under the 20-day moving average and we start to see some negative momentum readings, just be aware that when we hit zero buying pressure, there's probably going to be a squeeze, and then that can roll over very, very quickly. The key thing right now is the direct aim at the largest player in all of tech, right? Apple. But looking across the board right now, momentum has been weakening in recent days. We had zero selling pressure back on Monday. It is picking up now. That is a concern. There still is some strength in INTU, the UUU, but we're seeing weakness in Apple, in MGM. The XLE I already walked you through. Again, OILU is what we are paying attention to on the energy patch. When this breaks under its 20-day moving average, that's typically the time to go the opposite direction on oil production. That takes us to the XLE, which then followed. And we can also look at DRIP, double bearish ETF around energy production. We are not above our 20-day, but when the second that this breaks above the 20-day moving average, very good opportunity to take direct aim at the oil patch. You can see when this breaks the 20, it goes pretty quick. So we're looking for a move, not significant, but somewhere in that, buy for 1150 and sell for 1250, sell for 13. Looking for a sharp move, just energy prices moving lower. Again, not a lot of coverage in this space, and there was a lot of concerns again, just the lack of people hedging in this environment. This has been a very, very tricky last couple of weeks, and we're looking for a bit of a peel back into early June, and then the catalyst to move us back higher. That was our conversation yesterday. Okay, so looking at that, a couple of things to pay very close attention to. UVXY, the VIX is up pretty substantially this morning. SOXS, which is the inverse ETF for semiconductor stocks. So SOXS is starting to break higher. You get above that 20-day, go the other way and take aim at everything that is in the semiconductor space as well. This is, again, all linked to swaps. And because we are such a financialized economy, this exists, but it becomes a very good tool for recognizing the potential breakdowns. Again, very heavily financialized economy. We start to see all of the contracts that are linked to all of these different types of shares and bonds, et cetera, et cetera, et cetera. This is where we start to see real pain in the market. So SOXS, pay very close attention to that 20-day moving average. SBSW, still Bain. We are still watching what's going on in the patch for oil, gold, silver, other materials. Very solid. Looks like earnings report here. Breaking out toward the upside. Pay very close attention, though. Once we get into the start of the day, if we are overbought, these things can peel back. I'm going to walk you through something momentarily on how to trade volume weighted average price on a day like today. I love these types of days because it is Friday. There is pain. There are concerns. There's going to be sell offs. There's going to be overreactions. You want to take advantage of that, looking specifically at things that are trading in that really ugly downside third deviation band. We'll walk through that. Other names to watch: Booz Allen Hamilton, NUE, woohoo, New Corp. Again, dropping under its 20-day. It's been a precipitous move. I see a lot of downside here, but again, MFI is now oversold. Things can continue to move oversold. Crossover here on the MACD, negative move here on the RSI. Looking for a little bit more pain, maybe buying the 110, selling the 105, but Nucor Steel under pressure as well, and the UVIX. So we will pay very close attention to that. Do not be holding volatility over the weekend, whatever you do. And this is a day, again, 3-day weekend, a lot of opportunity for policy changes over the weekend. I remind you this, the key lesson, if you're trying to short heading into the weekend, just be aware, go back to 2020 and look at what the central bank did multiple times, injecting capital on a Sunday night. You will not have a way out of those positions in the event of a major policy change. And remember, we are operating on tweets in this environment. We are operating on where one single tweet or one single message on Truth Social can send this market up 500 points, down 1,000. So just be very, very cautious of that during non-market hours. The key thing today is what Trump said about Apple. Again, I talked about this last Thursday. This was such an obvious thing coming. So I didn't necessarily believe it was going to happen this week, but I certainly knew it was going to happen at some point. The criticism here is whether or not Apple should make its products here in the United States. And I own an iPhone, and boy, do I have problems with it, but it is what it is. If we look at this, though, it is virtually impossible for them to make iPhones in the United States at scale right now without significant amounts of investment that they might not even have. The estimated retail price, according to analysts, for Apple phones would be $3,500. The labor cost per unit is $200 here in the United States versus $40 in China, and I think $35 in India. Supply chain reinvestment, Apple would have to reinvest upwards of $30 billion over 3 years just to relocate 10% of its supply chain. Back in 2011, Steve Jobs and President Obama at the time had a conversation. Obama had asked about those jobs, and Jobs just simply said, yeah, they're not coming back. Materials costs are much higher due to lack of local sourcing. Keep in mind, it's impossible for us to mine in this country. Man, we can't do anything in this country without lawyers involved. Energy costs much higher than in China and India. Regulatory compliance, why even bother having the conversation? Very strict labor and particularly environmental laws. Every time we try to open a mine, here comes the Sierra Club off the top rope with a lawsuit. Cost advantages in electronics manufacturing. This is particularly India. Labor costs significantly lower, $40 per phone. I've seen this down at 35. Strong government incentives. They have a PLI scheme. They are really built around trying to get more manufacturing in their economy. And once again, India does not have the reserve currency. The United States has the reserve currency. This is known as the Triffin dilemma. This is known as the curse of the dollar. This is the concept where the US dollar has a resource curse to it, that the dollar crowds out manufacturing resultantly. This is why our economy is financialized. This is why we have seen that gutting of manufacturing over the last 55 years since we went off, since Nixon took the U.S. dollar off the gold standard in 1971. Resultantly, other nations have benefited. The dollar being strong, 20% overvalued last year compared to the G10, the U.S. dollar strength is a subsidy to consumers, but it is a tax on manufacturing. So resultantly, other nations enjoy these benefits. So when nations do engage in widespread subsidies for their manufacturing sector, the United States complains about it, but it is the fact that we have the reserve currency that makes it such a difficult proposition for us. We can sit here and we can subsidize. We would need full-scale reevaluation of the U.S. dollar and probably something significant to happen to the US dollar to make our manufacturing competitive. And I'm talking about a 20 to 25% decline in the US dollar's value relative to other G10 nations. You have to ask yourself, are you willing to do that? That's tough. That's a very difficult question, but it is one that remains very, very, very point and center in policy. It is not something that is discussed at the wide media level because, again, economists are not journalists and journalists are not economists. They're improving their infrastructure. They have a skilled technical workforce. They have lower energy costs. And India, no doubt about it, very strong strategic location, proximity between the Suez Canal and Asia as well. So obviously lots of access to markets. This is the breakdown. So again, at the end of the day, setting up the supply chain, the regulatory issues, the energy costs, the government incentives, the United States is going to try to get energy costs down. They should be trying to tackle the regulatory compliance issue, but again, it is a stark difference between India's regulatory setup and what we do here in the United States around labor laws and environmental laws. Government incentives here in the United States are limited. Yes, we can do things with our tax code, but once again, we are still bound and still structured by the strength of that US dollar. That makes it very, very difficult to manufacture here in the United States on scale. We will find cheaper ways to produce electricity, but at the end of the day, it is that labor cost. Those costs are passed on to consumers. The question, of course, is whether or not this is going to continue to impact Apple in any pronounced way. A 25% tariff would be very, very significant. So once again, if you are an investor in Apple, I will simply note this is probably going to blow over at some point, but it might be a little bit painful. Just understand that. It's going to take a little while. Maybe the administration buckles, maybe Apple buckles, but at the end of the day, Apple looks like it is heading back down toward that 180 level, possibly even lower. Everything on the technicals say ugly at the moment. And if you are an Apple shareholder, you can always remember that these inverse ETFs exist and you can buy them and hold them as a hedge. You can buy calls here. You can sell you can buy puts. I like the idea that if you are an Apple shareholder, every time that Apple breaks above the 20-day moving average on the AAPD, the inverse bear, go out a couple of bucks and buy a call for every 100 shares that you own. And in the event that the stock falls, this will provide a pretty ample hedge instead of trying to buy Apple puts to protect yourself in the event that the stock falls when the VIX is at 25, 30, when it costs a lot of money for insurance. Back here at this level, the VIX was down at 16, 17, 18. So again, this is why we got to follow those technicals. This is why we have to pay attention to these technicals because, again, over and over and over again, we see these breakdowns for Apple. And if you're turning around and trading AAPD, this is a $2, $3 move on a $15 ETF that's happening in about 2 weeks. Again, here, and we look like we're probably going to see a continued sell-off in Apple. That will weigh on the S&P 500, which will weigh on the MAGs. The MAGs is continuing to move a little bit lower. Pay very close attention, 2.3% from its 20-day moving average. And then the next thing you have to watch is the FNGD. And once again, we don't know. We don't know how long this will last. We do know that we have concerns around Japan. We do know that we have concerns around the market. I look at this and I say this is probably going to last another week and a half, and then we kind of gear up to that June 4th period that Gianni was talking about yesterday. All right, got any experience with the EU-approved listed average UK Ray? Okay, you guys are talking to one another. Had SOXL a month ago, but I can only get options. You can trade options on a lot of this stuff, but they're typically only third Friday for each month. So SOXL, FNGD, SPXU. If the S&P 500 breaks under its 20-day moving average, the SPXU becomes a bid. That is very close, 1% from. I love trading this thing, SPXU. If we get above this 20-day moving average, I will be buying the SPXU because, once again, this is a $2 move. But if something goes wrong, and I mean really wrong, it can turn into substantial gains. That's a $7 move. This was a $7 on 27 at the time. This is $7 on 20. And then obviously the big one, 13 on 25. It's cheap, it's easy, and it's a hell of a hedge. This is an ultra short S&P 500 ETF. Yes, there is decay. Yes, this is something that is a little bit more rocket fuel, a little bit more speculative, but it's cheap as a short-term hedge. You don't have to hold it for a week. Again, sometimes it'll just chop around. You're looking at a difference between 2161 and 2060. This is good protection for your broader portfolio. You just can't be in it that long if it drops back under its 20-day moving average. It is just a form of insurance. This is something that a lot of institutions use. This is a lot of retail use. You have to watch it and prepare for it, though. So just as we get into this cycle, I want you to pay very close attention to the SPXU. Don't trade it. Just watch it. Watch how it behaves. Watch how it chops. Look at its behavior between its 20-day moving average and its 50-day moving average. And again, it might be just range bound. We might be looking at something that's going to take us right back around next week. We might look at some sort of policy shift. A lot of things can happen. But this is where you want to pay very close attention because the narratives start here. They don't start in Barron's on Sunday, and they don't start in 2 weeks when we look back and wonder what happened. Price is telling us right now that there is something going on. Institutions are a little bit scared. Money is starting to move off the sideline, or is starting to move a little bit into protection. I want to be watching GDX as well. Once again, when it comes to gold prices, GDX and the 20-day moving average are match made in heaven. GDXU breaking above its 20-day moving average and its 50-day moving average a few days ago. And look how quickly this goes. This goes from $60 to $69 in about three and a half trading days. This can move quickly as well. 3, 4, 5-day trades, and everything about this is looking bullish. You have RSI moving above 50, positive move on the MACD, and that was the positive crossover on ADX that has been kind of the core tool, jumping above the 20 and the 50-day. All right, so moving into today, if you haven't done this before, I just want you to pay very close attention. Are you interested in any nuclear plays? No, I am not. I am not interested in nuclear power because nuclear power is not going to be part of our real grid run up until the mid 2040s. I am in batteries. I am in geothermal on a speculative side and natural gas pipelines. That is where my focus and energy remains, and it will not go away. I do not care about nuclear. What about BAH? Booz Allen Hamilton, this will be a fun one. Company getting crushed today. Well, this is what happens when the government stops consulting, paying for massive levels of consulting. Huge move down. So this becomes one of the names that we want to watch on volume weighted average price. Big drop down to start the day. And walk you through this real quick. This is TradingView, right? TradingView, tradingview.com. You can do this on Thinkorswim as well. But what we are doing right now, this is volume. Take that off. Take this off. I'm going to take everything off. That sounded wrong. Take everything off of this screen so that you can see how we set this up. So we're just going to go to the screen, go to tradingview.com, start completely over. Yeah, we'll leave. No big deal. SPY is the ticker that we will type in. Okay. And then when you need to reset, right click and hit reset chart. That'll take you where you need to be. Okay, so this stuff popped up again. We're going to take all this off again, just so you know that's there. We're going to switch to the 1 minute time frame. That is right here next to the little circle right here. And there is a replay available. Don't worry. Candles, indicators, volume, weighted average price. There you go. VWAP. Blue line. That is your volume weighted average price. This is an anchor point for a lot of algorithms. This is the first standard deviation of price. This band. Green, green. Okay. So now that you have volume weighted average price up, you can hide it. You can turn it back on. Then you got a little gear shift right to the right. This right here We'll come up with style. You can change the colors if you want. You can do whatever you want to do. It doesn't matter to me. But you're going to turn the other band multiples on. Okay, 1, 2, 3. And these are deviation of price. Okay. So, as Stanley Druckenmiller has pointed out time and time again, when things sell off in the market and we have aggressive sell-offs very, very quickly to the downside, you get down into the third standard deviation, fourth standard deviation of price. What that leads to is algorithms start buying. Algorithms start covering. And what Druckenmiller has complained about is that there's a lack of price discovery resultantly. Now, there's a lot of reasons why there is no price discovery in the markets. And the number one reason, don't tell anybody. The number one reason is the Federal Reserve. Because the Fed has not, as Luke Groman said a couple of days ago, the Fed has not sold a U.S. Treasury bond net since 2010, right? That's how many they are buying resultantly. So what happens in this environment, you get down here into the third deviation, and the funds start to bid and cover the electronic trading. And I want you to pay attention to that, because if you see deep selling and it comes down here and it hits this line, it becomes a contrarian bid. The other way to trade this is if you sell off and you start moving above the volume weighted average price, this becomes where you buy for the short term, and then you just sell it if it comes back under VWAP. You're hoping that you're going to see an ascending volume weighted average price during the day. When you get down here, I like to speculate on in the money calls at this line. So if this sold off at 9.45 and I bid back in, I would be buying the 568 call to expire today, right? It's going to take a big move down, something catastrophic, to continue to stay in that third, fourth, fifth deviation, if it even ever gets there. Usually will hit the fourth and revert, but I got to be quick here, and I'm just looking for a move back toward volume weighted average price. There is a $7 move between bottom of the third deviation and the 1 minute volume weighted average price at the moment. If you look at BAH, which is getting crushed today, resultantly, not a lot of volume, obviously pre-market, but a big move down. Pay very close attention. You'll probably see a significant amount of selling to start the day. And can this stock go down to 94? 100%. Could it go down to 100? Yes, it could. It will probably continue to stagger off, but pay very close attention, because this is a pre-market reaction. If we get down here, the stock may very well be a contrarian bid for a short period of time, because, again, 99 to 113 is the difference. Not 101 to 113 is the difference between two deviations of price right now. That's going to probably widen. So what you're looking for is down here. Hopefully we do get a sell-off. Hopefully we do see an even more pronounced sell-off to start the day. At some point, algos are going to step in and cover positions this afternoon. I like this environment during the afternoon, particularly 12 o'clock, 1 o'clock, 2 o'clock, when there's still low volume. The increased volume usually kicks back in the last 90 minutes of the day. People are asking about CRGY, Crescent Energy. Crescent Energy is again, when we started talking about CRGY, I had noted this is a 7-year process. This is a stock that is structured like a public-private equity vehicle in the energy patch. So big move last year. It is dropping under its 20-day at the moment. Obviously concerns about oil prices at the moment. If we start to see a lot of distressed assets, particularly if oil gets down to about 50 to 55, they are going to start deploying capital. This is a Tim Melvin stock. We've talked about this quite a bit. I like Crescent. I own Crescent. I have ridden it through a lot of challenges, and I still foresee it remaining a dominant player in the future. But we just have to be very, very patient with these types of names. Garrett, is it time to go to cash? No, it is not. We are not at a negative momentum event, but we're getting there. And again, I pay very close attention to the FNGD. That breaks its 20-day and breaks. I mean, that is a big gap, by the way, between its 20 and its 50. That is a huge gap. So again, probably expecting some chop. I did say on Monday when there was zero bidding, or forgive me, zero selling, that typically is the contrarian top, and that's where you want to take profits. You said if it breaks the 20-day to go opposite, you actually mean to go the direction the price is going when it breaks the 20. Yes, correct. But this is why you got to pay very close attention to these leveraged ETFs. So TECL, for example. This is tech, right? This is tech hovering at its 20-day. If tech goes, so goes the S&P 500. So TECS is what I'm paying a close attention to. If TECS breaks its 20-day, I am shorting a lot. And we are short LYFT from yesterday, as you know. Anyone who was in the chat yesterday with us, we bought the $18 put for 3 Fridays from now, 2 Fridays from now, June 13th, I think. Sorry, I had to stretch. And again, tech, and this was Engine Capital, a failed activist activity, big pop after the activist threw in the towel, move up to 1713, and just, again, negative crossover on the MACD. We were overbought for a week. I still like it at this level to short. My target's around $14, possibly just hitting that $14.77, just get me to the 20-day moving average, and I'm looking to take a gain on it. Anyone who is interested, we will be covering our final period today of Insider Week, of Whale Week. So we've talked this week about insiders. We've talked this week about how to use 13Fs. We've talked this week about Form 4 documents. Today we're going to dig a little bit more into the politics, politicians, and political insiders, and we'll talk about how to utilize momentum. Do you ever look at the 8-day EMA for reversals? No, I don't. I focus heavily around the key technical line that is around what I know my friends and colleagues use to shut they focus around the 20-day moving average. I focus on the leveraged ETFs. I focused on that for capital flow. And then once again, our momentum indicator is number of stocks in specific breakout conditions minus stocks in breakdown conditions. Our intraday movement is already flashing some warning signs. Does not mean anything significant. It's really when it comes down to that daily. And as I've said time and time again, sometimes it can be a false move. Sometimes it's just a retest of our moving averages. Just get back down to the 20-day, bounce off that for resistance. But I will just warn you, in a world where, again, we have had in the last 4 years, simple moving average, SMA, in the last 4 years, we have had 4 sigma or higher events. 4. Okay, these are 1 out of 63 years. These are multi-generational crises. We've had 4 of them. Silicon Valley banking crisis, gilt crisis, Nikkei crisis last August, which nobody talks about for some reason, and then this recent downturn that we just saw. This was a 4 sigma event, particularly around trade numbers. Okay, might not be reflective in stock pricing, but it was in concerns around trade. The numbers that we saw, 200 basis point move on the gilts in a day, the Nikkei crash, largest move since 1987, 4 sigma day. So this is why I continue to stress this. Sometimes there's going to be a little bit of a false flag. Sometimes you're going to hedge your positions, you're going to look to take some gains. There's no problem taking gains in a market. But just keep in mind, nothing good happens when our signal is negative, when our tech sector is negative, and then when the FNGD goes above its 20-day moving average. Bad things have happened. This is the most recent example. This is the Nikkei crisis. This was our sell-off that happened last year around tax season. This back here is the bond market going parabolic, the yields continuing to climb higher. This is the December sell-off, which was a significant amount of tax harvesting. That's your gilt crisis right here. This is the largest hedge fund sell-off in 15 years. This is the March sell-off that ultimately led to the Fed turning around and saying, it's just 25 basis points. Who cares? And then obviously, you know this one pretty darn well. That's COVID. So again, just play defense. You have to adjust. And what you're hoping for when it is time to build cash, you want to see these big moves down. You want to be hedged. You want to take aim strategically using things like the SPXU or going down into going out 2-3 weeks and buying whatever is at $1 on the S&P 500 or on the energy sector or whatever, however it is you choose. And then what you start to do in that environment is follow the pattern, right? If we get into an environment where there's no buying pressure, that's going to probably be a squeeze. And then you look for it to retest the 20-day moving average and then straight down. What do we look for then? Insiders to buy. Why are we looking for insiders to buy? Because there's probably going to be a policy shift. There's probably going to be accommodation by the Fed, or there might be accommodation through Treasury, or it might be another central bank globally, or there might be liquidity swaps, or in the most recent example, calling off the tariffs, because that spooked the bond markets as well. At the end of the day, it's all about providing enough comfort to the bond markets in order to get people to feel confident about whatever the hell it is we want to call this financial system. At the end of the day, though, you're always looking for the insiders to be buying at very high levels compared to where they're selling. Why? Because that typically accommodates a policy shift. And keep in mind, they spend a lot of money on consulting around Federal Reserve policy and government policy, particularly fiscal and trade. So resultantly, we want to see a lot of money flush in. We can follow those insiders just like we have had the opportunity to in 08, 11, 15, 18, 20, 22, 23, and most recently on April 8th, where we saw the strongest insider buying since December. It is 9:23. Donna's coming up. If you have not watched that review with me yesterday with Gianni, check it out. If you are interested in utilizing the Kelly criterion and making sure that you can manage your trades in very, very strong, smart ways, but also have that massive moonshot upside, this is for you. Check it out. There is a replay in the link. Just click on it. Check it out in a little bit. And I will be back later today. We will be wrapping up Whale Week. I hope you guys have a great day. And if I don't talk to you, enjoy your weekend. Take care. See you soon.